Welcome to the Explainer. Ever wonder how Wall Street actually puts a price on the future? Today, we're diving into stock options, and I'm going to show you the surprisingly simple secret behind their super complex price tags. Let's pull back the curtain. Yeah, if you've ever even glanced at option pricing, you probably felt like you were staring at, the code from the Matrix. Just this crazy, intimidating wall of green numbers and symbols. It kind of feels like it's designed to be confusing. But here's the thing. What if I told you that all of that complexity, all those scary-looking formulas, are really just built on one single, incredibly simple idea that anyone can get? Well, that's exactly what we're going to do right now. And that simple idea is this. There's no such thing as a free lunch. Now, this isn't just some old saying. This is literally the bedrock principle of modern finance. It is the key that unlocks the entire puzzle of how options get their price. So, let's see how it works. So first things first, what is an option anyway? In a nutshell, it's a contract that gives you the right, but, and this is the important part, not the obligation to buy or sell a stock at a set price. That little distinction, right, not obligation, that changes everything. You've basically got two main flavors. A call option gives you the right to buy. The best way to think about it is like locking in a concert ticket price before the band gets super famous. Then you have a put option, which gives you the right to sell. This is basically like having insurance on your house, so you can sell it at its old value even if the market tanks. Okay, so pricing something means predicting the future, which feels impossible, right? I mean, the future is messy and infinite. The secret is to simplify it. We're going to imagine the future isn't this chaotic thing, but just a simple fork in the road. All right, let's imagine we have a stock, and it's trading at a nice round number, $100 today. Now, if we take just one step into the future, we're going to say this stock can only do two things. It can either jump up to $120 or it can drop down to $80. That's it. This simple up or down model is the core building block for everything that comes next. Now, here's a really cool thing that happens when you add more steps. If the stock goes up, then down, it ends up at the exact same price as if it had gone down, then up. This little feature is called a recombining tree, and it's brilliant because it stops our model from exploding into a million different possibilities. Okay, so we've got our simple map of the future. How in the world do we find the price? Well, this is where we pull out our golden rule, no free lunch. In finance, they have a fancier name for it, the principle of no arbitrage. And honestly, it's kind of like a magic trick. So let's frame the puzzle. Our stock's at 100, we have a call option with a strike price of $90. If the stock shoots up to 120, our option is worth $30. Simple. If the stock drops to 80, our option is worthless. So the big question is, what is the fair price for this thing today? To solve this, we need a special tool. It's called delta. Don't let the Greek letters scare you. All it is our hedge ratio. It's a magic number that tells us exactly how to build a portfolio that has zero risk. And the calculation is beautifully simple. We just divide the change in the option's value, which is $30, by the change in the stock's value, which is $40. So 30 divided by 40 gives us a hedge ratio of 0.75. So what does that 0.75 actually tell us to do? It's a recipe. It says buy 0.75 shares of stock and, at the same time, sell one call option. Now, watch this. If the stock goes up, our shares are worth $90, but we lose 30 on the call we sold. Our net value is $60. What if the stock goes down? Our shares are worth $60 and the call is worthless. Our net value is, again, $60. No matter what happens, our portfolio is worth $60. We've created a guaranteed outcome. And this is the aha moment. We built something that's guaranteed to be worth $60 in the future. It's riskless. And remember our no free lunch rule? If something is risk-free, we know exactly what its return has to be. So we know the value of our portfolio today, and since we know the stock's price, we can solve for the one missing piece, the options price. That single step was the key to everything. Now, let's see how that same exact logic lets us build a complete, powerful pricing model just by stringing a bunch of these steps together. The method is called backward induction. Just think of it like solving a maze by starting at the exit and working your way back. You start on the option's very last day, where its value is obvious. Then you just work backward, one step at a time, using our risk-free logic at every single point, until you land right back at today's price. But wait a second. How do we choose the size of our up and down movements? We can't just make them up. We need to connect this to the real world. And the key ingredient for that is volatility, which is just a measure of how wobbly a stock's price actually is. This is what makes the whole model practical. So we've built this entire model up from one simple step. But what do you think happens when we make those steps incredibly small and we string thousands or millions of them together? Something pretty amazing happens. And here's the best part. As you add more and more time steps to our simple tree, making them smaller and smaller, the price you calculate gets closer and closer to the price you'd get from the most famous equation in finance, the Black-Scholes formula. They're two sides of the very same coin. By building this whole thing from the ground up, you've gained something way more valuable than just memorizing a formula. You've gained an intuition. You can feel how hedging and risk actually work at their deepest level. What you've just learned is the absolute core intuition. But if you want to see how to actually turn this into Python code or explore other really key ideas like Put-Call Parity, then you should definitely dive deeper in the full article on Simplified Zone. We've dropped the link for you right in the description below. Thanks for watching The Explainer. At the end of the day, what we've really seen is that finance isn't magic. It's just about finding incredibly clever ways to eliminate risk. And once you can do that, you can pretty much price anything. So, what will you try to understand next?